Hello, everyone, and welcome back to another episode of Sipping Wealth Live, where I bring you news, tips, and tricks on how to wealth up. So, y'all, today I am going over how to write off your vehicle on your tax return. So, I'm going to be going over the ins and out. I'll give you about 15 to 20 things that you need to know. Make sure that you keep in mind when it comes to writing your vehicle off on your tax return. So for those of you tuned in with me, thank you. And be sure to hit the subscribe button and the notification bell on the Sipping Wealth YouTube channel. Come on, y'all, trying to get these subscribers up. Let's get these numbers. And also make sure that you hit that share button and as well on all social platforms, whether you're tuning in from LinkedIn, Facebook, the Facebook groups, whatever, or YouTube. Go ahead and hit that share button so your friends, families, loved ones, all that good stuff could wealth up with us. And also, for those of you tuned in, be sure to drop a comment in the comment section. Let me know who's tuned in with me. Drop a hey girl, something in the comment section. As well as if you have questions, things like that throughout the live, go ahead and drop it in the comment section as well. And I'll make sure that I address it later on. But yes, y'all. All right, let's get into it. Okay. So, like I said, I'm going to go over how to write off your vehicle on your tax return. So generally, when writing off a vehicle on your tax return, you need to be using the vehicle for some kind of business use. So if you're just W-2, maybe you have you only have a W-2 job, and no rental property, nothing like that, then this doesn't apply. But if you have 1099 work, gig work, maybe you have some money that you earn on the side, maybe you attend pop-up shops around your city, and you're like, some kind of business use, or 1099 gig work, freelance, any of that. If you do any of that, then you're in business. Okay. So some people, they do freelance work or gig work or things like that, and they don't, or 1099, or they receive a 1099 and they don't consider themselves as business owners. But actually you are in business. As soon as you have that self-employment income, that income that's outside of your W-2, that you're working, or that earned income that's outside of your W-2 that you're working for and things like that, hey, you're in business. All right. So like I said, that requirement is to make sure that you are using that vehicle for business use. So it doesn't matter if you self-finance the car and the vehicle is under your name and not the business's name. You can still use that vehicle for business and take advantage of these deductions. Okay. It's just that the personal usage side of the vehicle, you can't deduct. So you're going to have to differentiate between the mileage and the expenses and everything that you use for a business versus the amount that you use for personal for the vehicle. So once you kind of create those two categories, there are apps out there, Mile IQ, QuickBooks, whatever app that you want to use, or if you want to do it manually on an Excel spreadsheet, however you want to keep track of this. Just make sure that you're separating your business and your from your personal as far as your usage for your vehicle. And that could be either your actual, maybe you want to keep the gas receipt separately. Maybe you want to keep, your gas for your business versus the gas that you're running around for a personal use. Maybe you go to Orlando from Jacksonville every weekend to sell your goods, and you write off that mileage, that travel mileage. And then during the week, you're working your regular 9 to 5, or you're doing personal expenses. So maybe you want to do that, and you want to take advantage of that mileage that you're going to Orlando for. Just an example. So this is based on percentage of usage. I kind of hinted at. So you can deduct, like I said, only the percentage that's proportional to your business. So let's say that based on the mileage and things that you use for the vehicle versus your personal, you use the vehicle for 60% business and then 40% personal. That means only 60% of the expenses associated with the vehicle you can write off as business expense. Now, the other 40%, because it's personal, you can't write that off. But that doesn't mean you just throw the entire deduction away. It just means, hey, 60% of it you can take advantage of, and then the rest you cannot. All right. So, and that goes for your, if you're doing the standard deduction route with the mileage deduction, or if you're doing the actual with maybe you held on to your insurance premium, maybe it's a lease vehicle, so you're writing off lease payments, you know, whatever. So based on that. So the standard, which I kind of hinted at, the standard mileage rate, it's actually 65 cents this year. So 65 cents per mileage that you use for business. And this checks every year. I mean, this changes every year. I said checks. This changes every year. So in the previous years, it was 60 cents, whatever, 58 cents, da da da. And then for this year, we had the 65 cents. So for each mile that you use for business, that's a 65 cents, deduction. So if it's, 1,000 miles, you multiply that by 65 cents. Now you have your deduction amount. All right. Then that's, quick and easy. Now, and then you have the actual method, actual expense. The actual is, hey, instead of using the standard mileage, I want to use like my gas. I want to be specific as far as the amount that I paid for gas, maintenance, insurance, and I want to be able to take the depreciation on the vehicle. So, and with this method, you want to make sure that you are keeping receipts for it, or you're scanning it into your Google Drive or your app, whatever. But you want to make sure those receipts are somewhere, just in case. All right. So if you do the actual method, it's kind of one or the other. So when should you do the standard or the actual method versus the standard method? In some cases, the only method you can do is the actual method, depending on the type of tax return you're filing, the type of business tax return you're filing. Now, let's say if it's a 1040 individual tax return. Now, if you're trying to figure out, hey, should I use a standard method or should I use the actual? When should you use the actual method? When you actually have detailed records of, the receipts and everything that you use for gas, insurance, maintenance, and the depreciation for the vehicle. When you have that, we lit. Now, if you don't have that, then, you just want to go ahead and use the mileage for the vehicle and then do that route. Now, if you say, hey, also another reason why you may use the actual method is if the actual expenses are higher than the standard deduction amount or standard expense amount, mileage rate amount. So if that 65 cents doesn't equate to all the money you put into that car that year, maybe you had a lot of maintenance or repairs or whatever on that vehicle that year, then you want to go ahead and use the actual method and take advantage of those actual expenses because you have record of it. And then you want to make sure that you take advantage of all the expenses associated with that. The other thing is depreciation. So with the depreciation, this is used on the actual method for the vehicle. So the actual expense. So the depreciation works on the amount that either the value of the car at the time you started using it for business, or if you purchased it that year, then the amount that you purchased it for, and then it'll go break down to a percentage amount. So, and then you're able to depreciate it over, say, 5 years. So over the next 5 years, you're going to go ahead and take expense out. If you're just doing the regular depreciation on this, I'm not talking about the accelerated depreciation or bonus depreciation. If you're doing regular depreciation, it's going to essentially get divided out based on the time you purchased or time you started using it for business. And then it's going to get divided out by that time period so that every year you're going to take a depreciation hit on that vehicle or expense on the vehicle. Now, if it's a lease vehicle, then you're not going to take depreciation. You're just going to write off the lease payments. But on the other side, if it's a finance vehicle or it's a vehicle that you own, then you're not going to write off the car payments. you can do the depreciation for the vehicle, but you wouldn't write off the car payments unless it's a lease vehicle. All right. Now, the big thing a lot of people talk about is the Section 179 deduction. So Section 179 deduction says, hey, if your vehicle qualifies, if it hits the 6,000 pound limit, then you qualify for the Section 179 deduction. And for this year, it's 80%. So 80% of the amount of the vehicle, or the cost of the vehicle, the basis, essentially, you can go ahead and deduct that in the year you purchased it or you started using it for business. All right. So before, in the past, you could do 100% depreciation, but now it's 80%. Then you'll go to 60%, and then we'll die down until we no longer have the Section 179 deduction, unless they change the tax codes or anything like that. But the depreciation is decreasing year by year, so it'll be 60%, then 40%, and then it's gonna phase out. So it is phasing. All right. And then, but the other part is bonus depreciation. So you can have a vehicle that qualifies for the Section 179 deduction and additional bonus depreciation, which is you're essentially depreciating a larger amount of the vehicle in the first year. So you're taking that accelerated bonus depreciation in the first year. And again, it's different qualifications and things like that you would qualify for in order to take the Section 179 and the bonus depreciation. All right. And generally, your tax professional will advise you on that if your vehicle qualifies for it. All right. But those are, you can stack them. You can have a 179 deduction and you can have the bonus depreciation as well. All right. Luxury vehicle limit. So my people that want to top of the line, for my luxury vehicles, or vehicles that are considered luxury vehicles, and that's the vehicles that are over a certain amount, there is a limit as far as how much you can deduct for depreciation and the 179 deduction. Okay. So again, if your vehicle is over the threshold, I don't have the amount readily available, but if your vehicle is over that threshold, then you're considered to have a luxury vehicle. And the Section 179, it ends up reaching that limit, and you can't do the 179 deduction or the depreciation. It's like, hold up, you can afford to pay taxes because you're driving the top of the line luxury. But yes, that's what that is. Like I said, for the lease vehicles, you're gonna write off the payments for the vehicle, and it goes again for my luxury vehicles. But the luxury vehicles, once again, if it's over the threshold, then we have restrictions as far as how much we can write off for the luxury vehicles, depending on how much it is. Ooh, y'all, that liquid. They ain't paying me for this endorsement, but liquid, where is it? Liquid Death, boy. Be hitting the spot. Okay. Next, interest. So if you are making payments on your car and you have that interest on the loan, a lot of people don't take advantage of this deduction, but you can actually write off the interest that you're paying on the loan, the car loan, because that part is not necessarily being appreciated, but you can take that expense, right? But now, like I said, it goes back to the percentage of usage for business. If you're using a business 60% for business, then 60% of that interest that you're paying to that bank for financing that vehicle on the loan of that vehicle, you can go ahead and take as a deduction. Or maybe you're using that vehicle specifically for business. Maybe you have two vehicles, and that truck is what you use for business specifically, and then the other vehicle you use for personal driving. Then 100% of everything associated with that vehicle is business, because that's the vehicle you're using 100% for business versus the other one you're using for personal usage. Record keeping, y'all. I say this every live because it is crucial. It is fundamental. It is beyond important. So important that you are keeping track and detailed records of what's going on with your business, your miles driven, the date, you have a log, the destination, what was the purpose of the trip or the purpose of the drive. You need these detailed logs because in case of an audit, they're going to ask you to give this to them. And they don't give you much time. They give you about 15 days. Sometimes they can extend it, but generally they give you about 15 days and say, hey, we want this record on our desk. We want it sent to us within this amount of time. So send us that log since you want to take, the business mileage deduction or whatever, or the business vehicle expense. So you want to make sure that you are keeping record of it, because it doesn't make sense writing off and putting a stress over your head because you don't have it properly documented. Now, in case of an I had to find out what happened, what trips I made, how many miles was the trip, all this. Like, it makes it a lot stressful when you have to provide this. Audits can go very smoothly. It doesn't have to be a headache. And when it comes to an audit, it could be as simple as getting the paperwork, sending it off to them because you already know your ducks are in a row. And they'll get off your back and they'll go about their day. All right. Home office exception. So for my people that work from home for their business, if you have like a home office and that's where you work from, and then you occasionally, let's say, you do trips from home to another work location, that's okay. But if you're just doing a little commute, staying home, then of course that's not deductible. If you're running to the grocery store and coming back home to your home office, then no. But if you're making trips from your home to a work site, maybe you have to go to a supplier to pick up the merchandise. Maybe you have to do all these other things, get the supplies, get the equipment, whatever, and bring it back to your home office. That's okay. But if you're just running errands and then going in between on your lunch break and going back to your home office, yeah, no. All right, y'all. But the home office is deductible now, but we're not talking about home office deduction. We're just talking about vehicle. Deductible expenses could be, like I said, gas, maintenance, repairs, tires. Maybe you had to fix a window, registration fees, licenses. Like I said, depreciation or the lease payments, loan interest, things like that, parking, tolls, all that. Those are some of the most of the deductible expenses for the most part. Everything associated with the car. Personal property taxes. If you do have personal property taxes on the vehicle, then that's deductible as well. Now, if you have generally the vehicle expenses and things like that are claimed on a Schedule C 1040. So what is a Schedule C? A Schedule C is essentially the profit and loss for your business, or maybe you're just a 1099. Your income and your expenses associated with that 1099 work will still run through the Schedule C. And that's for a 1040, which is the individual tax form. Now, if you're an S corp or a partnership or whatever else, then things work a little differently. But I'm talking more on the individual sense today. Following on that 1040 individual tax form. And then for those of you, I get this question a lot. Some people, they come and they're like, hey, I filed my personal tax return. Now I'm ready to file my business. And, I come to them, I'm like, hey, you're supposed to file your business with your personal return. It's this additional forms that go on your personal tax return to reflect the business part. So make sure that before you file unless you're a C corp, like Inc., a C corp, not an S corp, unless you're a C corp, you have to make sure you file that business tax return. The business tax return before you file the personal. Because a lot of the times with my partnerships, with the S corps, you have a form that goes onto your personal tax return that to reflect the business income or the business loss for that year. And even if you're not neither an S corp or partnership, maybe you're just a sole member LLC, or maybe you're just a sole proprietor, a person with an EIN or a 1099. You have to make sure you file that with your personal tax return. So you do want to make sure that that's why your business taxes are due on March 15th, but your personal taxes are due on April 15th, to give you time to get your business, your partnership, S corp, those filed, so you can have the numbers available to have your taxes filed for April 15th deadline, for your personal tax deadline. All right. So you do want to make sure, hey, you're talking to the tax professional before you jump on TurboTax and file your personal taxes. And then you realize, oh, shoot, I have to amend my personal tax return because I didn't add my business to it. All right. Reimbursements. If you have a W-2 job or you have an employer that reimburses you for vehicle expense, then you cannot go again and take a deduction on the vehicle, because your employer is already providing you with a vehicle allotment or reimbursement or stipend. So, and so you don't go in and take those deductions again. And generally that, or like an accountable plan or things like that. Those tend to be those reimbursements tend to be non-taxable anyway, so you don't take the deduction on top of it, because you already be reimbursed and all that for it. Make sure that you're tracking mileage. I went over this with record keeping. You can use an app. I named a couple. And then make sure that you're speaking to a knowledgeable tax professional that you can trust. Because tax law can change. It varies. Like the 179 deduction changed from 100% to 80% to 60%. So it does, like things like that, tax codes and laws and things like that are changing and shifting every year. So you do want to make sure you're going to a knowledgeable tax professional that's up to date on what's going on, so that you can have the best outcome and return on your tax return, and that is done properly and accurately. Okay. Because you are signing off on this tax return saying that, hey, I stand beside this. I know everything that's on this tax return and it's accurate. Okay. So you want to make sure that, everything's checking out properly. Okay. All right, y'all. So that was about 20 or so things that I wanted to make sure that you understood, as far as when it comes to writing off your vehicle on your tax return. So like I said, make sure that you are properly record keeping, and that you are making sure that you speak to a knowledgeable tax professional. All right, y'all. Thank you for joining me for another episode of Sipping Wealth Live, where I bring you news, tips, and tricks on how to wealth up. See y'all next week.